Hello, everyone. Welcome back to the Weekend Charts. Charlie Bilello here. As always, I'm going to run through some of the most important charts and themes that I'm seeing in markets today. If you're watching this on YouTube, hit that subscribe button for more content just like it. What are we going to be discussing today? A lot of important topics going on. Inflation, of course, number one on everyone's mind. We'll dig through that inflation report. We'll talk about Fed expectations, how they've shifted after the report. Is this the start of the first correction for stocks that we've seen this year? We've been talking about very bullish sentiment, maybe a little bit of signs of greed. Well, is this going to be the first pullback? We're going to discuss meme stocks, reversion to the mean in meme stocks, fast food. If you've been to a fast food restaurant, you probably noticed not that cheap anymore. Prices gone up a lot in the last decade. We're going to quantify that. And we're going to end, as we always do, with something positive, and that's rising donations worldwide. So, number one, inflation is heating up. We got that CPI report for March. We were expecting it to show a higher rate of inflation. That's exactly what we saw. 0.4% increase in the month of March. So that's 2 straight months now, 0.4%. And over the past year, inflation moving up to 3.5%. So that's the highest reading we've seen since last September. And if we look at core prices, very important here, excluding food and energy, which tend to be more volatile, well, that actually ticked up to 3.8%. That was the highest first tick up that we've seen in inflation, core inflation since last March. So since March 2023, it's been a year of declining core inflation prices, but we saw a tick up there for the month of March. So overall, worse than expected. And importantly, this is a continuation of the trend here above 3%. So 36 consecutive months, 3 straight years now where we've seen CPI above 3%. And that's the longest streak of high inflation in the US since the late 1980s, early 1990s. We see this streak here of 54 consecutive months back then. And if we look at the deviation here, and this is the important chart that I keep pointing to, this is the 2% trend line. So if inflation had stayed at 2% since the beginning of 2020, this is where the CPI would be. Instead, we're up here 11% above that trend line. So every month that we're above 2%, this is going to widen, and certainly at 3.5%, this is going to widen even faster. What's the breakdown in terms of components? Why did we see a rise in the CPI from January to March? So 3.1% in January, 3.5% in March. Well, combination of different factors. First, you had the fact, and we've talked about this, that commodities are declining at a slower pace. If we look at fuel oil and gas utilities, you see those big year-over-year declines in the month of January, less negative in the month of March. So that's one factor there. You can see gas flipping from negative prices there year over year to positive in March, another big factor. And if we look at things like transportation, it continues to be an issue here, rising 10.7%. I'll talk about a little bit one of the factors driving that. But one of the biggest reasons here is this shelter component, which simply hasn't come down as quickly as many expected. It was 6% in January, still highly elevated here at 5.7%. Why is shelter so important? Well, it's the single biggest component of CPI at over a third of the index. So what are the drivers in terms of gas prices? What's the trend there? Well, we're seeing the trend move in the opposite direction that we saw from the back half of last year. Prices falling. Now prices are rising, highest since October 2023, $3.71 a gallon national average. If this continues to rise, it's going to continue to be a headwind for CPI. So we saw, of course, gas prices peak at over $5 a gallon back in 2022. Huge decline after that, but now we've essentially gone sideways. And if we look at year over year prices, if we continue to rise here, this is going to be a bigger impediment. So going to be much harder to get below that 3% level if we see another spike higher in gas prices. And in terms of transportation, the price and cost of driving is getting more expensive. And one of the big reasons for that is the fact that auto insurance rates continue to rise. Now, 22% increase in auto insurance rates over the last year. That's the biggest year-over-year increase we've seen since the 1970s. So big factor driving higher transportation costs. And if we look at that shelter component, again, most important component of CPI, We're above 5% now for 2 straight years. So 24 consecutive months above 5%. That's the longest streak we've seen above 5% since the early 1980s. So very important in terms of the housing, because it's the single biggest component for most households in terms of their budgets, and seeing this huge inflationary spike in the single biggest component obviously causing a lot of problems. As we talked about many times, this shelter CPI operates with a lag and is still expected to come down, but the fact that it's been stubbornly high there at 5.7% still is a concern. Maybe it's not going to come down as much as people were thinking. And I'll talk about next week about the rising cost of insurance, of maintenance, and a lot of the other ancillary costs in terms of home ownership have been really rising at a faster pace than the overall inflation rate. And perhaps that's one of the reasons why we're still seeing elevated shelter CPI. So what else do we get in terms of inflation data? We got producer prices, which had been pretty moderate, below 2%, but we've been saying this is a leading indicator for CPI, and we saw last month a tick up, and we saw another tick up today. Not huge, obviously 2.1% increase year over year, but that's the highest we've seen since April 2023. Commodity prices and other components in terms of the producer prices moving now in the opposite direction. So again, that'll be an additional factor likely to put pressure on consumer prices. And if we look at import prices, this had been a huge tailwind in terms of helping bring CPI down. The fact that we had 13 straight declines on a year-over-year basis for import prices, but now we're back into positive territory. And so we'll see, we'll monitor this closely. But again, this was a tailwind. Now it's likely to be a headwind in terms of overall prices, something to watch pretty closely going forward. So overall, prices are not going down. They were rising at a slower rate, but now we have the fact that they're moving in the opposite direction from 2%, and we'll talk about in a little bit what that means for the Fed. But clearly a big concern for markets, and we'll discuss, is this going to be the impetus for the first real major correction that we've seen in the market, which has been a very smooth sailing rides higher so far this year. So just a reminder, creative planning, tax day is coming up. We do tax planning, we do estate planning, we do wealth management, we do everything. We're in all 50 states, over 300 billion in assets under management and advisement. So if you're worried about inflation, you want a second look at your portfolio to see if you're positioned correctly for the future, reach out. We're here to help. This is a chart showing you the last 30 years, what has happened in terms of the value of your dollar. It's been cut in half. And if you look at investment in the stock market, inflation adjusted return 867%. So this is what I point to primarily for people to illustrate why you should think about investing. You need to have assets in your portfolio that will not only keep pace with inflation, but potentially have the opportunity to outpace it. And so if you're thinking about your own portfolio, how you're going to protect against inflation going forward, reach out. You can go to creativeplanning.com/Charlie. I'll have a link in the show notes as well. Number two, the most absurd number in CPI. This is absolutely ridiculous. When I tweeted it, people were 100% agreement saying this doesn't make any sense. This is the fact that the health insurance component of CPI is actually showing a decline of 15% over the last year. And even more absurd is that they're saying it's actually down 3% over the last 5 years. And if you talk to anybody, no one's going to tell you that their health insurance is lower today than it was 5 years ago, but that's exactly what the US government is trying to say with their calculation here. And the reason for this is they're not usually actual premiums. They're not usually actual consumer purchases of health insurance to determine this inflation. What they're using, and this is kind of bizarre and kind of crazy, they're using the retained earnings of insurance companies. So they're using what's essentially profits of insurance companies to tell you whether there's inflation or not. And because over the past year, they're saying that insurance companies had to pay out more in terms of claims as people are using their insurance more, I guess, retained earnings have gone down, and therefore they're saying health insurance inflation is lower and the overall cost is down over the last 5 years. Again, this makes absolutely no sense. I understand it's a difficult thing to measure, but there has to be a better way than using retained earnings. And I don't think this leads to any credibility in terms of people believing the government inflation numbers when you have something as crazy as this, when you have a system that's showing healthcare prices down over the last 5 years, when we know, everybody knows, healthcare prices have far exceeded the cost of inflation over the last 5 years, and over the last 20, 30 years have seen just enormous increases as well. So they should absolutely fix that, dig into that. I'm not sure that they're going to, but it doesn't make sense under the current system. Definitely, in my view, the most absurd number in CPI. See you in September. We have to talk about the Fed. Huge shift in market expectations following that inflation report. A little surprising to me because this was kind of expected. We were saying for the last month, we're going to get a hot CPI. We're going to get a hot CPI. All evidence seemed to be pointing to that. And yet the market reacted as if this was a complete surprise. What we saw is the probability of a cut for that June meeting essentially go from over 50% last week and over 70% a month ago to now just 27%. So markets saying really doubtful now the Fed will have the ability to cut in June. And that kind of makes sense because if the Fed is looking at this data and they want credibility or want to retain credibility with their 2% inflation target, well, we're moving away from 2%, not only in terms of the headline number, but the core number as well. And if we look at the market's expectations for the full year, very interesting. We came into the year with the market predicting 6 to 7 rate cuts this year. Now the market is saying only 2 cuts, and the Fed funds rate will end the year at 4.88%. Now, of course, a lot can change between now and then, but as it stands today, market expecting a much less dovish Fed than when we entered the year. And the impact this has had in terms of the bond market, well, we're seeing bonds fall, yields rise pretty much across the board from looking out 1 year and longer. You can see here 1 year treasury yield coming into the year was at 4.79%, now at 5.18. We look at 2 years gone from 4.23 to 4.92. The 10 years 3.88 to above 4.50 this week, and the 30-year 4.03 to 4.58 with the yield curve still inverted. So the longest inversion in yield curve history is going to continue even longer because we're not going to get that rate cut in June. It's going to be pushed out, it seems like, to September and maybe even later. We talked about last week, there's a few Fed officials saying maybe we only get one hike cut this year and maybe we get none. So I think if the data doesn't improve from here significantly, there's not any reason for the Fed to cut rates. They should stand pat. That would be the right decision. We'll see if they actually do that. But less and less evidence for the Fed to point to saying they're going to have a sustainable move back down to 2%. So we got the FOMC meeting this week, minutes this week, and these minutes were during the last Fed meeting, which is before we got this inflation report. So certainly this would impact that. What they said in the minutes was that they need more confidence that inflation is moving towards the 2% target, and they talked about uncertainty about the persistence of high inflation and saying recent data had not increased their confidence. And this was, again, before that CPI report. So obviously, with that report, they're not going to have more confidence that they're getting towards their 2% target because they're moving away from that 2% target. So very interesting that the Fed was saying this before the CPI report, and likely at the next Fed meeting, which is in early May, you're going to hear them talk about this report and say we have to wait and see a little bit longer. Now, at the same time, we're pushing back rate cut expectations. You would think that we'd be pushing back expectations for a reduction in quantitative tightening or the speed at which the Fed is reducing its balance sheet, but that doesn't seem to be the case yet. There was this article in the journal saying that the Fed is preparing for a slower pace of runoff from their $7.4 trillion portfolio. And This is from the FOMC minutes as well. They said the vast majority of participants judged that it would be prudent to begin slowing the pace of runoff fairly soon. So what does fairly soon mean? We don't know, and perhaps that inflation report will change their opinion, but it seems to be they're talking about reducing quantitative tightening. And to me, this is very premature. We've reduced it by a trillion and a half in terms of their balance sheet, but we still are far away from before we started that massive quantitative easing in 2020. And so if inflation is still a big problem, it seems to be, why are you going to stop this quantitative tightening? Why is the Fed so eager to slow the pace of this quantitative tightening? What people are saying, well, they're worried that it's going to cause, if we continue to reduce the balance sheet at this pace, it's going to cause problems for money markets. We're going to see a spike in yields there. We haven't seen that yet. And to me, that would be more of an argument to say the Fed needs to get out of this market and stop manipulating things. If we're so dependent on the Fed to have a stable money market, well, that seems crazy that if the Fed doesn't print money and they don't go in and buy these securities, that we're not going to have a stable bond market, then that's a real problem. So we're increasing the dependence on the Fed by continuing this. I don't think that's a good idea. We'll see what happens here. Perhaps when we get to the next meeting, they'll push that expectation back. But I don't think there's any reason or need as it stands today to reduce this quantitative tightening, continue to let this roll off and get back to a more normal state. This was supposed to be a crisis measure. We had the crisis in March 2020, bond markets going crazy. We could debate whether the Fed should have done what they did and how much they did, but the crisis ended and the Fed continued to buy these bonds for a few years after it ended, right? And so that's the big issue. After the crisis is over, they're unwilling to bring it back to where it was before. And they're starting to say things like, well, if they do that, it's going to cause another crisis, another problem, which to me is a signal to say the Fed's gotten too big and we need to reduce these powers for the future so we don't get in this situation again. Higher for longer impact. This is important to evaluate now that we're not going to see likely that cut in June unless something crazy happens in the next few months. Not going to see that cut. So rates are going to stay higher for longer. What is that going to impact? Well, anything that's tied to interest rates, obviously credit card debt and the cost of credit card debt is going to stay elevated. We actually got a new reading on that, moved up to 21.6%. This is the average rate on US credit card balances. Record high. We have data going back to the 90s. We've never seen credit card interest rates this high. So this is going to stay elevated. And likely, as long as it stays elevated, is going to reduce the demand for new credit. So if people are paying higher interest rates on credit, we're going to see a slowdown in demand. And that's what we've seen pretty much every month over the last year, a pretty sizable slowdown in terms of new credit being issued. And obviously, in terms of things that are financed, we've talked about mortgages a lot. I'll talk about that again next week. But in talking about car market, over 80% of new cars are financed. So people aren't coming with cash and buying these cars, which have become much more expensive, 40, 50,000, 60,000 and up for new cars. Well, they're financing it, and that finance cost has gone up 400 basis points over the last 2 years. We're looking at now 8.57%. That's the highest rate that we've seen for new car loans since 2001. So you have to go back over 20 years to find these rates this high. And as long as the Fed is staying higher for longer, these rates are likely to remain elevated. Now we have the government debt, obviously a huge one here. Interest cost on government debt continuing to rise. Now 1.02 trillion. That's another record high over the last 12 months. And with every single month, you have these old securities maturing. Federal government is issuing new debt at higher interest rates. And so that interest cost goes up. So you have the combination of two things. Number one, we're borrowing more. We're borrowing about $200 billion a month to finance things because we're spending 200 billion more a month than we're taking in through tax revenue. And so we have more debt and we have a higher interest rate on that debt, higher average interest rate every single month. So this is likely to continue as well. And we talked about this as potential one of the reasons why the Fed might cut interest rates before it was warranted. But with inflation at 3.5% and perhaps going to stay above 3% for longer than expected, it seems for now this issue is going to be put on hold, and the government will essentially continue to borrow money to pay the interest on the money they've borrowed. So, not a good situation, trending in the wrong direction. But as long as interest rates stay higher for longer, unfortunately, this is going to become worse and worse and more of an issue. And perhaps the good thing would be this would lead to some fiscal prudency to say we simply can't do it anymore. That hasn't happened just yet, but we'll see as we approach the election. I suspect it'll become more of an issue if this really starts to accelerate higher. So, is this the start of the first correction in the equity markets? That's what everyone's been asking. We talked about this as perhaps being a catalyst given very low volatility. Expectations were getting a little frothy. There was a lot of different signs of froth in the market. And when we see this rise in interest rates, we saw it last year when it starts to really accelerate. That's when we got the correction last September, October in markets. Now we're seeing interest rates rise again on the 1 year, on the 10 years. We talked about above 4.5%. Again, is that going to lead to fears here enough to drive the market down? We'll see. But certainly the market was not positioned for an increase in volatility. What I mean by that is we had very, very low VIX levels coming into the month of April. VIX was in the 12s. Now we have VIX approaching 19, so very quickly spiking higher. And as I talked about last week, what you should expect when you have a very low level of volatility, well, at some point you should expect to move higher. There's mean reversion and volatility, and don't get complacent when things are very low in terms of volatility. It's only a matter of time before volatility comes back into the market. And then we have the fact that sentiment in terms of greed, very rare to see extreme greed this high. We saw 62.5% bulls in the Investors Intelligence Survey, 48% spread between bulls and bears, which is highly unusual to see. We hadn't seen it the last time since 2021. And what we're talking about here is simply too many bulls got in one corner. They got too bullish on the market, and perhaps a correction will likely, in my view, alleviate this. And as we talked about last week, this is not necessarily saying the market can't be higher a year from now, but the average is following extreme levels of bullishness tends to be lower forward average return. So your expectations should come down when everybody is starting to get a little greedy. Here's a chart of the S&P 500. We've been above the 50-day since last November. We talked about last week the NASDAQ 100 breaking below that 50-day. So we'll see as I'm talking now, still above it, but in danger of breaking below it before the end of the day here on Friday. So that would mark a change in trend as well. We already saw it again with the NASDAQ 100, and likely today, unless we see a reversal before the end of the day, likely another 1% down day. And as we've been saying, very, very low volatility, very unusual to see this few number of 1% down days or more. And maybe we're going to start to see more of that. So very normal what we're seeing. Average year is 3 to 4 corrections of greater than 5%. We had less than 2% drawdown coming into the week, max drawdown. And so we're at 2 and change now if we close at these levels today. So nothing huge whatsoever, going down 2 to 3% off its high, still very benign. So this is well within normal. If we got 5 to 10% correction, we see that almost every single year in the markets. And interesting thing here is showing you the demand for gold and silver continues to accelerate. And we saw gold breaking out to all-time highs back in early March, and just continuing to run up, and a lot of money pouring into gold and silver. A lot of different reasons for that, but sentiment has shifted, and the narrative, the story is all that matters with gold and silver. These are assets that are driven primarily by the story, and the story for gold and silver is that you have a situation where the national debt's going to become unsustainable. You have inflation being an issue again, and that's going to eventually cause problems. Gold is viewed as a safe haven during those periods of time, and now actually above the S&P in terms of its performance year to date, up 15%, with silver up over 19%, S&P 500 up 9%, and starting to move down. So if we look at the last year, what's been interesting is that a lot of people will tell you they're buying gold because they're worried about the dollar going down. And the long term, maybe that'll happen, but it hasn't happened this year. It certainly hasn't happened in the last year. The dollar, this is a look at the dollar index ETF, actually up over 10% over the last year. And what we're seeing here is gold up 16%. So certainly gold is not higher because the dollar is moving down against other currencies. That's not happening. Gold seems to be going up in every currency. We're hearing China buying more and other central banks buying more as well, being a factor. But interesting to see gold doing as well as it's doing with the dollar very, very strong. Why is the dollar strong? Well, big part of that is that higher for longer thesis, and that the Fed is going to stay more restrictive for longer than other central banks. So we talked about Switzerland already cutting interest rates. We talked about a number of the emerging market banks cutting interest rates, particularly in Latin America. And here we have the Fed saying probably, at least the market's expectation for the Fed is they're not going to cut until September, and they're going to stay higher for longer and perhaps only cut 2 times this year. And so I think strength in the dollar, and dollar, of course, being a safe haven as well. If there is a correction, money tends to go to the dollar as well. So all of these factors, I think, driving the dollar higher. But clearly, you can see gold is not dependent on a lower dollar to go higher. There is a negative correlation there, but it's certainly not -1 in terms of gold and the dollar. They can both go higher together. They can both go lower together, and this is another example of that. So speaking of correlation, what I like to point out to people is that correlation doesn't equal return. So even if something is correlated, it doesn't mean they're going to have the same returns. And I think the best example of this over the past few years is looking at the US stock market and the US bond market. It had a correlation over the last 3 years of 0.69. That's the highest correlation on a 3-year rolling basis on record. So stocks and bonds going back to the 1970s haven't moved together on a 3-year period this much in history. So just a fascinating thing. We've discussed this before. Primary reason why they're moving together is that inflation has been the big concern over the last 3 years. And when inflation is a big concern, you have both the stock market and the bond market reacting negatively to rising interest rates. Of course, the bond market, when interest rates spike, is going to go down, but the stock market historically hasn't always been the case. More often than not, when interest rates are rising, stocks are higher. But during an inflationary period, that becomes the source of fear. So you have these two things tied together. And so very interesting. We have this high correlation, but if you looked at stocks and bonds over the last 3 years, well, two different worlds, right? We've been talking about stock market hitting all-time highs, over 20 all-time highs this year. Meanwhile, you have last 3 years in bonds down 9%. Stocks are up 30% over the last year. So huge differential. So just because they're moving together most of the time on months doesn't mean the magnitude is the same. So clearly, when stocks have been up in terms of up months, they've been up much more than bonds. So even though directionally they've been tied together more than they have been over the past 3 years, they in terms of performance, bonds, when they're getting hit on the downside, getting hit harder, and stocks are rising when they're on the upside, rising much more. And if we look at the last 5 years, extend this out, it becomes even more dramatic. Bonds slightly lower and stocks up 95%. So certainly great 5-year period for stocks, well above average, talking about 14% annualized. And we've talked about the reasons for the bond market decline, the fact that interest rates were so low 3 years ago and 5 years ago, that rise in interest rates causing big problems for bonds. Going forward, you should expect better returns for bonds because that starting yield is higher. But just interesting to see here, it's been a very strong market for equities in spite of higher interest rates. So far, at least, we had that period in 2022 where interest rates were hurting. Higher interest rates seem to be hurting stocks because of fears of inflation really overwhelmed things. But since then, the exact opposite. We've seen higher interest rates not be a problem for stocks whatsoever. And that's more in line with the historical basis. So we'll see from here. Will stocks and bonds trade together going forward? Well, I think that's going to be dependent on whether inflation continues to be a factor. And as long as it's a major factor in the markets, you're going to see this tighter relationship between stocks and bonds. Let's talk about reversion to the mean, a little play on words there. What am I talking about here? And this has been one of the big consequences of a return to normalcy in terms of Fed policy, in terms of interest rates. Well, it's the fact that meme stocks have reverted. And we don't often talk about these names today, but back in 2021, this was all anyone was talking about. This is a list of most popular meme stocks from back in 2021. Of course, the two most popular being GameStop, GME here, and AMC down here. And you can see the declines across the board, most of them down 90% or more from their 2021 peak, and a lot of them hitting new lows this week. So really a return to normalcy in terms of the markets, caring about profits again, caring about fundamentals, less speculation in terms of markets. The one exception I talked about last week and the week before being that Trump media situation, which to me smelled a little bit like a mania because you have this company trading at a $10 billion market cap with only a few million in revenues and a big net loss last year. And that seems to be reverting back to the mean here as well. It's now down over 60% from its peak on the first day of trading. So return of normalcy, higher interest rates kind of crush this type of speculative activity that we saw in 2021 with ultra low interest rates, and the stimulus programs created this mania, really a mania that we haven't seen since, I would say, the dot-com bubble back in 2000. And today, much different market in terms of fundamentals being much more important driver of returns than speculation or memes. Fast food isn't cheap anymore. I think anyone who's been to a fast food restaurant the past few years probably has been stunned, as I have been, saying, gosh, I don't remember prices being that high. This is getting absolutely ridiculous, and trying to calculate in your head how much the increase has been over the last few years. Well, there was a study here done by Finance Buzz looking at 10 menu items over time. So they looked at prices starting back in 2014, and then they're looking at it today, same items, so 10 different items, and they're saying what has been the increase over this last 10-year period. And interesting, McDonald's here, and I talked about this a few months ago on the show, McDonald's 100% increase, so prices doubling over the last 10 years. Just crazy, crazy increase in terms of prices for McDonald's, and anyone who's been there probably recognized that. And when I tweeted this out, the most common response wasn't, oh, this is wrong, prices haven't gone up this much. The most common response was, I don't think the prices for these Subway and Starbucks at 39%, I don't think that's accurate. And if you look at the price of coffee, or you look at the sandwich prices at Subway, a lot of people are arguing, I think rightfully so, the price increases seem to be much higher for that. Maybe it's the fact that they're looking at 10 different menu items. So maybe there's some items at Starbucks that haven't increased that much, and they're just taking an average of that. But really crazy that the prices for these fast food products have increased way above the rate of inflation, which is 31%. So you're talking about doubling in prices at McDonald's when overall inflation is around 31%. And what I said a few months ago, and I'll say it again today, maybe this is a maybe this is overall a good thing because it's becoming cheaper for you to buy meat at the grocery stores and cook your own burger, and it's probably going to be, let's be honest, a better burger than you're getting at McDonald's, and you could do it for cheaper. Maybe this is going to finally lead to a decrease in demand for these fast food products that aren't that healthy for you anyway. And Americans certainly could use a little push to stop eating at these locations. But so far, I think that there hasn't been a huge decrease in demand, and that's why these companies have been able to push up prices so much. So I think ultimately, and I've talked about McDonald's, I don't understand how the share price has remained as elevated as it has. We've seen now a 10% decline over the past few months, so maybe getting back to reality, but there has to be that pullback in demand ultimately from the consumer for these companies to say, we can't push up prices anymore. Consumers are starting to leave. And so ultimately, there's enough competition here, I think, to keep prices in check as long as that demand starts to come down. But I think this is just yet another reflection we talked about last week in terms of grocery prices and the study that the Wall Street Journal did showing that prices had gone up well in excess of what CPI was showing. Well, I think this is just another example saying perhaps the CPI's calculation in terms of inflation is really understating things at looking at 31% over the last decade when we're seeing all of these price increases much higher at all of these fast food places. Now, of course, fast food and eating out is only one portion of your budget, but this is becoming a trend here. We're talking about trend in terms of home prices, in terms of health insurance, car insurance. All of these factors seem to be going up well in excess of the rate of inflation. People's incomes simply aren't going up as much to keep pace for that. And I think that's why you still see sentiment curiously low, even though stock prices are at all-time highs and home prices are at all-time highs. People are still feeling this impact, and they don't like the fact that prices have likely gone up more than what the government is telling them in terms of the reported inflation rate. So I want to end with something positive, as I always do, and that would be rising donations worldwide. So great thing to see. If we look at 2013, 28% of people, this is a Gallup poll, said that they had donated some of their money to a charity. And in 2023, that number moved up to 37%. So great thing to see, more people giving money. Obviously, this means more prosperity in the world over the last decade. Hopefully, this is a trend that continues, something that we can all hope for. And with that, I'll end it right there. Covered a lot of ground today. Hope you enjoyed the show. Thanks for watching. If you're watching this on YouTube, hit that subscribe button for more content just like it. Have a great weekend, and I'll see you next time on The Week in Charts.